Investors often spend less than 3 minutes reviewing a pitch deck. A decision is already forming much earlier than that. After reviewing thousands of decks, I've learned the biggest signals aren't in the slides themselves, but in how the founders think. There are 7 red flags I consistently look for, and sometimes just one is enough to walk away. Hi, I'm Rupa Popat, the founder and managing partner of Araya Ventures and House of Araya. I manage over $50 million in venture capital funds. I'm backed by the British Business Bank. I've co-invested alongside over 100 VC funds, including some of the world's best. I see thousands of pitch decks every year, and here is something most founders do not realize. On average, investors spend less than 3 minutes on a pitch deck, and in many cases, we have already formed a view much earlier than that. So the question is not whether this is a good deck, it is what signals I am picking up almost immediately, because those signals compound very quickly. When investing early, you are not just evaluating the business, you are evaluating how clearly someone thinks, how they prioritize, how they see the world, and why they are building this at all. In early stage investing, motivation and insight often matter more than the idea itself. So these are not just deck mistakes, these are all signals. Before I go through all 7, subscribe if you haven't already. I frequently upload videos detailing how to evaluate early stage companies the way professional investors do. And stay until the end. The 7th red flag is the one most people miss completely. Subscribe. Let's continue. Red flag number 1. If I cannot clearly understand the problem in the first 20 seconds, that is a concern. Not because the problem is not real, but because the founder has not articulated it clearly. Strong founders can explain who has the problem, why it matters, and why it is painful very, very quickly. The best founders I back can usually explain the problem in one sentence, and that makes you immediately understand why this business matters. It is not about being polished for the sake of it. It is about whether they have thought about the problem deeply enough to distill it clearly. If that clarity is missing, it can mean either the problem is not well understood or it is just not that strong. Red flag number 2, market size that feels vague. You often see statements about very large markets, but no clear explanation of how the company actually captures that opportunity. Strong founders do not just describe the market, they show where they start, how they expand, and what part of the market is realistically theirs. If it feels too abstract, it is usually because the thinking is too abstract. Red flag 3. Every company needs a starting point, a wedge, a clear way in. If I cannot see who the first users are, why they should adopt this, and what makes them switch, then the business is just not grounded yet. Signals grounded in real behavior are powerful. One of our AI portfolio companies in the AI agentic space has already won tenders against a very well-recognized incumbent software company at the pitch stage. That mattered to us because it showed us something far more important than whether the product worked. It showed us exactly who their ideal customer was, where they could win, and why someone would choose them over an established alternative. And that is what a real wedge looks like. It is not a vague belief that the product is better. It is a clear evidence that in a specific use case, someone is already willing to switch behavior. Without that, it is very hard to get started. Red flag 4. Distribution is another major signal, particularly in AI. The product might be strong, the demo impressive, but there is no clear answer to why this will reach users and keep reaching users better than everyone else. Across our AI portfolio, there is not just one type of distribution. There are multiple defensible paths, including channel partnerships, open source distribution, community-led growth inside places like Discord, deep workflow integrations, or owning specific customer relationships. The best companies do not just acquire users, they build distribution that compounds, and if distribution is treated as something to figure out later, that is a major gap. In AI, distribution is often the moat. One of the things I've seen a lot recently in decks is a strategy to go after paid ads. Red flag number 5. Sometimes the deck looks very polished, but underneath there is very little substance, no real detail, no nuance, or no depth. Strong founders do not need to hide behind polish. They can go deeper when you ask questions. Just a reminder to subscribe if this content is useful. 2 more red flags to go, and the last one is the one I see most often. Red flag number 6. The absence of a unique insight. The idea might sound good, but there is no clear insight behind it, no reason why this team sees something others do not. The best founders always have a perspective, something they understand deeply that is not obvious to everyone else. Without that, you are simply executing on a known idea, which is much harder to win. Red flag number 7. One of the most important signals is whether there is a real reason this team has to build this. The opportunity might be large, the deck might look good, but if there is no clear connection between the founder and the problem and solution being built, no lived experience of the problem or no domain insight and no strong personal motivation, you can just feel the difference and you can see it in the deck. The best founders care deeply about the problem that they're solving. They have seen it up close, understood the nuances, and have chosen this problem for a reason. Without that, it often becomes an idea without the depth required to win. In early stage investing, you are not just backing an idea, you're backing someone's relationship to that idea. All of these red flags are not really about the deck itself. They are about how the founder thinks, their clarity, depth, judgment, and motivation. And you do not need to see all of those signals to decide not to proceed. Sometimes one is enough, because in the early stages, decisions are made quickly, often within minutes, and these are the signals I have learned to trust over time. I've put together a free pitch scorecard, the exact criteria I use to evaluate any deck I receive, 25 criterias across team, market, product, traction, and terms. Score each one, total it up, and you'll know immediately where a deal is strong and where it has gaps. It's called the Startup Pitch Scorecard. Download it. Keep it open the next time you review a deal. It will change how you read every pitch from now on. The link is in the description.